Hello and welcome to Legalese. My name is Vincent Perryman and I am a local attorney with the law offices of J. Vincent Perryman. Each month, Legalese focuses on a wide range of legal issues and topics. Today's show covers tax preparation. With us now is CPA Gus Wilson. Gus, thanks for being with us today. This is sort of our annual update on what's changed with the federal tax laws. So, what's new?
Well, Vince, thanks for having me on again. I think that everyone's aware that tax season was once again upon us, and that there are a whole new variety of weird tax rules, provisions, credits, refunds that the government's just kind of thrown on the table to try and help us in these troubled economic times. I think that the hot one right now is the homebuyer's tax credit. If I could ask your permission, I'd like to circle back to that one later, because there are some very intense rules and regulations and a lot of dotting your I's and crossing your T's and what have you. So without further ado, I'd just like to handle the small stuff first and then circle back to the big stuff.
Yeah, and just for clarification, we are talking about the 2009 taxes in this, because that's what's being prepared here to be filed in 2010.
That's correct. It's February-ish around this taping, so I guess that everyone's going to be ready to file or is probably in the process of filing right now. I know that I'm trying to gather up my information, and I'd like to think that everyone else is as well, or, you know, at least preparing to file an extension.
Right.
Very first thing on my list, and keep in mind that most of these are new laws that have either been promulgated this year or have been extended from prior years, and so it's mostly 2009, 2010 type updates. The sales and excise tax paid on qualified vehicles is now deductible, and you know, that doesn't sound like a whole lot of like a big deal, but it really is, because it's something you can add to your standard deduction. So even if you do not itemize, you can take it. However, if you're in Tennessee, you're probably already taking your local sales tax deduction. You can't take both, unfortunately. So for our Mississippi viewers who are watching, and anyone else in a state where they don't deduct local sales tax, this is a really big benefit. Once again, the vehicle has to be new. There's certain rules and regulations, and I'm going to say this a lot, but please see a tax advisor before you just jump into something willy-nilly like this.
So, and I guess the next thing on your list that you gave me was the Hope Tuition credit was expanded? That's
right. Just a brief overview. The Hope Tuition credit is a credit offered to students attending college, and it's for the first 2 years. What they've done is expanded it. It's now called the American Opportunity Credit, and instead of being a $1,800 deduction, it's a $2,500 deduction. And instead of being allowed for only 2 years, it's now allowed for 4 years. So if you're in school, this is a big deal. There are some phase-outs, but they have been raised and they're very generous. Remember that even if you don't qualify for the Hope Tuition credit, there's always a lifetime learning credit to fall back on, which is the same as normal, and it's for any year that you're in college, and it's $2,000.
Now, if I've got a child that's in college and I'm paying that tuition, do I get that Hope Tuition credit?
You get it.
Okay. Now, we've heard a lot about the Making Work Pay credit, which, you know, I'm always under the assumption that if you're working, it should be paying. So
the Making Work Pay credit is something that most people have already seen by way of payroll deductions, and that's your W-2 earners. Me, probably not you, but most of us have seen it already. And really, there's a whole myriad of problems with this thing, but suffice to say that you received a credit, and you got to really watch it. You know, if some people, it's going to change their threshold for their safe harbor estimated payments and make them actually incur a penalty. Some people are going to not withhold enough and are going to owe some penalties at the end of the year, and so this is one of those really sticky situations where the government really thought they were doing us a favor. They could have just written us a check and we would have been happy. It really, I mean, it's beneficial in some aspects, but really it's going to be difficult to handle, and it's probably a lot of people are probably already running into difficulties with filing of it. It covers pretty much, though, I mean, as far as who gets it, pretty much everyone gets it. As long, I've got a little bullet point list here, but as long as you are not a non-resident alien, you're not an estate or trust, as long as you can't be claimed as someone else's dependent and have a valid Social Security number, it's yours.
Okay. And then the next thing on the list was the qualified energy efficient home improvements.
That's right, and that's another really big one right along with that home buyer's credit that everyone's really curious about. Obviously, fuel prices are acting strangely. I wouldn't say they're through the roof like they were about a year and a half ago, but they're still they're climbing. And so there are some provisions made in the tax code for some purchases of energy efficient appliances. It's been expanded, so it's something that did exist up until 2009, but it existed in such a fashion that it was almost not worth taking. I think it was 10% of the purchase price of the efficient appliances, up to $500 aggregate over your lifetime. So what they've done now is they've said it's 30% of the purchase price for the 2 years in aggregate, up to $1,500. And remember that it has to be on your principal residence located in the U.S. And so you can't put it on your rental property and you can't put it on your vacation home. It has to be your primary residence. The rules say that the appliance has to be certified, and you can't just look on the box and where it says, certified Green Star. You can't take their word for it. What you need to do is do your research, do your due diligence, and I think I've got the website here. It's EnergyStar.gov is the place that you want to go to research that stuff. In addition to the energy efficient home improvements that we've also got new rules and regulations but for solar heaters, electricity generating property, and wind energy. And these things, this is great stuff if you were looking at solar cells or fuel cells or something like that. For solar heaters and solar products, you can write off 30% of the cost, which is a big deal. There's no cap like the $1,500 for the appliances, and so it's a pretty big deal. The old caps were about $2,000 and $4,000 depending on what we were talking about, solar versus fuel cell versus wind. They've removed those caps now. The other rule for this one, that's different from the energy efficient home improvements, is that it doesn't have to be your primary residence. It could be another dwelling as long as it's in the U.S. Rental property, vacation homes would qualify for this. And remember, just kind of an aside, yes, some pool heaters are solar, but you can't deduct a solar pool heater. It's kind of a frivolous type of expense, and the government's pretty much said, that's not what it's there for. It's there to generate electricity.
Okay. When we return with our discussion about tax preparation, please stay with us.